Good morning, good morning. All right. I think some more food is coming. I guess they weren't expecting us to eat this much, but no big deal. So, well, this is the second Markets and Mimosas, and we're excited to have everybody here. We have Ben Sullivan. He does a lot of work with us, CFA, does a lot of portfolio management. He's going to talk about 30 minutes on markets, on portfolios, just what we're going to see maybe potentially in the next 6 months to a year. But first off, I want to thank our team for putting on this event. They're awesome. We have the absolute best team. And I know I'm biased, but you all have had a chance to work with everybody at our office or seen us. And we are so thankful for them, and we're thankful for you as well. I also want to point out, you probably saw communication that Tracy, which a lot of you know, passed her CFP examination a couple weeks ago. But good for her. You know, as we get older, it's harder to learn and harder to memorize, so.
Wait, take that back.
Yeah. So what an amazing accomplishment, and it'll serve you very well. So I want to mention just a couple of things before Ben gets started. So this summer, we have an amazing event coming. It's our client appreciation event. So a lot of you folks came last year, right, to the MAPS museum. We had an amazing time. So this year, we're actually doing it at MAPS again, okay? And it is going to be, I think, an amazing event. We got a different twist coming this year. You're going to get communication on what we're going to be doing this year. But I wanted to point out, this year, every year, we're going to try to incorporate some kind of charity, some kind of, sorry, I guess I got to stand in front of the camera. Sorry, Stephen. So we're going to incorporate some kind of charity, some type of foundation that we can get behind. So this year, we have chosen Folds of Honor. My dad and I were a couple months ago out in Vegas, and we had contributed to the Folds of Honor. And one of the experiences were to go shoot guns with Navy SEALs for a couple of days and go to dinner with them. And we just had an amazing time, just not only getting to know the guys that we were with that day. So this summer, for our client appreciation, the guys that we actually shot with that day are actually coming to our event, which is going to be amazing. So we got 4 Navy SEALs coming, and they really stand behind Folds of Honor. What Folds of Honor is, it's basically a scholarship program for the kids of mom and dad that may have passed away overseas, fighting for our country and our freedom. And what they do is they provide scholarships for those kids. And we're hoping to raise some money this year, and you'll get some kind of communication that we can get behind a scholarship, help some kids go to school, go to college, because their mom or dad fought for our country. So thanks so much for coming. Appreciate every one of you. Appreciate working with you. And Ben, I'm going to let you take a look.
Wow, that's what an incredible cause. I'm familiar with Folds of Honor, really wonderful organization, really meaningfully impacting, the families that have been impacted so much by serving our country so deeply. Like Ben said, my name is also Ben, so you're just gonna get Ben all morning. I'm from Advisors Excel Wealth Management. I basically provide market updates, commentary, all of those types of things, investment strategy, forward-looking projections. We'll just do the regular mic here. That sounds a little better. We're gonna figure this out together. Here. Perfect distance. All right. So my general day-to-day with the families here at Integrated Wealth is to really just help them be the most informed that they possibly can to serve you guys in your financial plan. And what you're going to hear me talk a lot about over the next 30 minutes is how we got to where we are in the markets, where we're at right now, where I think we're going. But the thing that I really want you to understand and concentrate on is to think about your own financial plan, not just the stocks you own, not just the annuity that you own, not just the way that you take income and distributions and live your life and all of those things. It's how all of those things work together as a part of the plan to allow you to do all of the things you're wanting to do in retirement. That's the most important piece of this. So always think back to that, the plan and how that all works. I always like to kind of give it in the timeline. So I'm going to go way back to 2020 very briefly so we can talk about, because I think everything that happened in the first quarter or second quarter of 2020 really puts us right where we're at right now. So it's important for us to really hone in on that and talk about that for a second before we get going on anything else. So if you remember, we had the coronavirus problem. Obviously, everything shuts down. How that pertains to the markets is really when it comes down to the economic stimulus that got put into the economy, right? People couldn't work, they needed additional funds, the government was worried about people's cash flow, being able to pay their bills, all of those types of things. So we saw unprecedented money put into the system. Now, the important thing for you to understand about that is that when you have that type of stimulus, it is only a problem if the economy slows down, right? So the basic principle of inflation says, if I add more money, but I've got more growth, then I don't have a problem. But the second that I have more money and I don't have more growth, that means there's less demand, or there's more demand and less supply, and prices rise, gets us to inflation that we've experienced over the last 18 months, right? That's really important to understand. The second thing to understand about 2020 is we saw all sorts of reform acts to reduce taxes. We saw less taxes generated. We saw additional contingency secure act and all of those types of things that came out that, again, really allowed households to keep more of what they were making, right? Those things are all inherently good. We all like more money in our bank account, and we saw higher savings per person in their bank account than maybe we've ever seen ever in the country. And those things were really good. All of that made a ton of sense. And the market responded really positively. The best way I could say it is the S&P 500, which is the largest 500 US corporations. It's really the guideline for what drives how I view the market. There's, roughly 2,000 companies that are measured overall for the US economy. But when you really focus in on those top 500, that's really where we get a good barometer for how all of that functions and where our economy and our markets are at. And the S&P 500 dropped almost 30% in the first quarter. And I mean, just every day was just plummeting every day. It was a really challenging time. It was really scary. We didn't really know what was going to happen. Cue the stimulus, cue the tax cuts, cue the Secure Act, all of those types of things. The S&P actually was back to being positive by the time we hit July 1 of that year. It was the shortest bear market in the history of the US economy. Bear market is, of course, measured by gross domestic product, GDP. And if it's negative, that's how you know you have a bear market 2 consecutive quarters. So we snapped out of it, almost overnight. And I think what happened was the market sort of looked at that and said, okay, we're out of this problem. All of that COVID issue stuff, as far as the stock market is concerned, is behind us. And it was reflected in that way. The S&P finished up by a wide margin that year. 2021 proceeded to be a really good market again the following year, being up almost 21%. And I think it kind of just went by the by. But as you recall, I told you, all of that money doesn't matter as long as there's growth. As long as there's growth and the US economy is booming, we don't have a problem. Well, we started to see that become a little bit of an issue. The US economy started to slow ever so slightly. Prices started to rise ever so gradually. And then we sort of got the bill coming due in 2022, right? Market was down 18% in 2022 after being up 26% in 2021. So a huge swing of almost 44% in difference in experience. And the main driving factor of that was inflation. In March of 2022, you get a 9% inflation print. That means that just for the same goods that you bought the previous year, they cost almost 10% more than they did a year ago. That's significant when you think about housing and groceries and gas and your rate to buy a mortgage or a car or things like that. Suddenly overnight, the average auto loan went from being around 6% to around 13.5% for an auto loan. And when you think about that, what I really want you to say to yourself is, what does that mean for the household savings? That unprecedented high dollar amount that people had in their bank accounts for savings and reserves in case of disaster, invest more, buy more small business items, go on vacation one extra time, which stimulates the economy. Those weren't options anymore because the average cost was eroding that savings at a higher clip than it was previously. Makes sense? So that's the important thing is how much do people have to spend, because there's a technical term in the investment world called M2, which is basically the money supply. It's an aggregation of all of the money that's out there and how often it changes hands, right? So there's a term called the velocity of money, the speed of money. And what that really means is if I get paid by my employer and then I go to the grocery store and spend that dollar I just got paid at the grocery store to buy groceries, and then that grocery store turns around and pays their employee, and that employee turns around and spends it to buy and pay their mortgage. The rate that money changes hands is an indication of how strong the economy is and how well or how confident people are. And the reason that is if money slows down, the speed of money slows down, that's an indication that people are saving it. They're more nervous about the next 60 days or the next 6 months or the next 5 years. And so they're less likely to spend more money on discretionary things, going out to eat, buying a new TV, buying a new car. They're saving it because they're not confident. So when we see that into that speed of money slowing down, that's a great indication that sort of murkiness is on the horizon. And that's sort of what we started to see in March and April. And so classically, how did our friends at the Federal Reserve deal with this problem? Well, they raised interest rates, right? They raised the cost to borrow, which means people are less willing to spend. It takes money out of the economy. It soaks up some of that. People buy treasuries, buy CDs. That lowers the money supply that is out there to try and bring inflation down. And it sort of worked, right? It did, as you've seen, inflation over the last year and a half has slowly dropped. It's come down. It took a little bit. It was at 9. It got really scary. It spiked up to like 9.5. Then it went 8, then 7, then it sat around 6 for a while. And then for probably the last like 8 to 9 months, it sat around 3.25% change. Again, when you see that number, that 3.3%, like the one we just had earlier this week, what that means is it is, again, the rate or the change in the cost of your goods. So that 3.3 means a year ago today, your goods were 3.3% cheaper than they are right now. That's really what that means for all of you. And so the long-term goal of the Federal Reserve is to get that to 2. They want the rate of cost of everything to be at 2%. I personally don't know why we can't have it at 0, but that's for smarter people than me. I don't know why things have to always get more expensive, but that's just one of those little ironies that they're out there. The problem is now is getting it from 9 to 3 has proven relatively easy overall for the Fed. They've just steadily raised rates. They got up to 5%, all of those types of things. But getting it from 3 to 2 is going to be a big problem. That's going to be the big issue. And I'll explain a couple of reasons why. There are 3 main drivers of inflation out there. The money supply, which we've talked about a lot. 2, the demand for goods, right? How much people want stuff. If you remember back in 2020, you couldn't find a Peloton bike anywhere. I mean, the wait list suddenly exploded to like 6 months. I know because my wife is a big athlete enthusiast. She likes to do a lot of physical activity. And we tried to get a Peloton bike and it was impossible. We never actually ended up getting one. We were on the wait list for over a year by the time we finally gave it up. Remodeling your home, there was a huge demand for that. A lot of people took time. They spent more time in their homes, and funny enough, they looked around and found a bunch of stuff they didn't like about it, so they remodeled all their houses. We redid our bathroom. Again, I was part of that. And so that demand spike really drives inflation when there's no supply, because it's natural. Corporations want to maximize the amount of money they're making. And so if there's a huge demand for something and there's only one of them, they're going to just keep raising the price until a bunch of people fall off and only one person's left willing to pay that price. That's how corporations kind of function in that way. So that's number two. So money supply is number one for inflation, demand's number two. And then number three is employment. And the numbers on the jobs is maybe the most difficult number to understand in any part of the economic data. If you follow any of that stuff, payroll, inflation, interest rates, the jobs numbers are really tricky. And there's a couple of reasons why, and I'm just going to give you the caveat here. One, any statistic that involves people filling something out and then relaying that information through several different entities, there's always room for huge error and lag. Those employment numbers that they're getting, just a simple example, in January of this year, the employment numbers, the US economy added 100,000 more jobs than they thought the US economy was going to add. And the market ripped upwards, had a really positive outcome. Well, they got more data in over the last 3 months. They understood the numbers better. They scrubbed it out. And if you paid attention, and it never hits any headlines because it never does, they reduced that number to only 20,000 jobs over expected. But the market had long since already dealt with that and acted like it was a really positive thing, but they looked at the data, they ruled some people out, said, oh, there was some mistakes made and all of those types of things. So I only say that to say those jobs numbers that hit the headlines and all of that, they're pretty misleading only because there's bias and there's error involved, because myself and human beings are involved in that sampling process and how they label it. And so it's just an imperfect science. The second thing is we have just now gotten back to the same employment levels that we had pre-COVID. And that's a really important thing. Nobody in the jobs numbers ever puts it in perspective of like, they just say, hey, we've added a bunch of jobs, so it seems really positive. But in COVID, in February and March, 200,000 US jobs disappeared overnight. People who couldn't go back to work, corporations laid a bunch of people off, or they just eliminated the jobs altogether because we didn't know when the shutdown was going to end. We didn't know what the world would look like after that. So we've slowly but surely been working our way back to that. So when you hear these full employment numbers, just understand that we're just now getting back to pre-COVID levels as far as how the jobs are functioning. All right. So money supply, demand, jobs. That's really how inflation is impacted at its core. All right. So the last thing I'll leave you with as far as the recap of the market before I jump into where we are now and where we're going is when you talk about volatility, right? That means the ups and downs that you experience every day in your portfolios, your investments. One of the key principles to investing is time. Time is your friend. We know that markets work. That's what I tell people all the time. Markets work. It doesn't feel like it in the moment, but they do. And so if you think about just the last 3 years, remember those 500 largest companies, 2021, markets up 28%. 2022, markets down 18%. 2023, markets up 26%. When you look at that over just 3 years, if you just ignore those 3 annual returns and just look at it, the market has been very positive over that 3 years, but the experience that you and I have felt has been, not a great one. There's been tons of news, the market's bounced all over the place and things like that. And so I only say that to remind you that the people here at Integrated work really hard at understanding these principles about how markets work. And when they design your plan, they do it in a way that understands that the markets might be choppy over any given month or year, or even 2 years, but over 3 years and over 5 years and over 10 years, those markets work, and they know that those are going to get you the results that you want. And again, if you would just ignored your portfolio, not looked at it a single time, come back 3 years later today, you would feel like it was a win. Like everything went really well. The plan worked exactly how you needed it to work. The markets did exactly what you needed it to do for your plan. So please continue to think about that whenever you think about like when I look at Yahoo Finance and I see that the S&P is down today, just remember to yourself, yeah, but over 3 years it did really well.
over 5 years, it did really well. It feels a little painful right now, but overall, I think we're doing really, really positively in that regard. So just a quick note on that as we get to this point. All right, so where are we at today? A couple of really important things as it pertains. Again, we're just going to keep talking about the S&P because it's the best barometer we have. It's not perfect, but it's the best barometer we have. 55% of the S&P performance over the last 15 months is from 5 stocks. There's 495 other ones that have contributed to the other 45%. That seems out of balance. Your math is very good. That's what we call a narrow market, all right? So NVIDIA, Microsoft, Google, Amazon. Those are the big ones that are driving the market. It was Apple, but Apple's not had a very good 2024, largely because of the antitrust issues. And then there was Facebook was having some things going on, and there was a couple of other ones, but 55% of the S&P 500 returns. So there's 495 stocks out there that haven't really had much of a say. Why that matters to you guys is that's what's known, again, as a really narrow market. That means we're really concentrated. There's 5 things that have really driven it. That can go one of 2 ways then for us. The first is we can see those 4 or 5 names pull back and the rest of the market pull back with it. And that can mean a lot of short-term kind of pain in the S&P 500 for all of us over the next couple of months. Or it could be like what happened in March, which is it's called broadening out. The market broadened out, which means people were selling the technology stocks, but they were buying the other 495 because they were looking at it and saying, there's a lot of good value here. There's a lot of good deals on the table. And the way I know that is if you look at how those 5 names performed over just the last 30 days, they underperformed the other 495 by about 5%, which is a good indication that that's what's happening here. That's good news for all of us because that means less volatility. If they were taking profits out of those big 5 and buying bonds or treasuries or CDs, that would pull the market back precipitously. That would cause us a lot of problems. And so it's a good sign the way that the market has behaved over the last 30 days. Now, where do I think we're going? This is the pull out my crystal ball, rabbit behind the, rabbit out of the hat kind of thing. I always like to give this little caveat, and I haven't quite ever figured out if this is an endorsement of what I do or a lack of it. It puts me closer to, like predicting the weather. But if you looked at all of your major institutions, Morgan, Merrill, Bank of America, every year they put out what they think the S&P is going to do this year. Every year they do this exercise. Every single year they look at all the data, they look at how it performed, and they say, what do I think it's going to do? The average investment firm for 2023 predicted the market would be up 6. The market was up 28. The average investment firm in 2022 said the market would be up 2 in 2022. The market was down 18. If you're sensing a theme of, wow, these guys don't seem to be very close, you're right. The problem is, and it's not really a problem, it's that they're assessing these things on January 1, and then January 2 happens, and 3rd and 4th, and all these events transpire, and geopolitical things come out, and the Fed, who's a human being, Jerome Powell, makes a decision about what he thinks interest rates should be. And so all of those things are just educated guesses. And then we kind of have to play the game, right? Like, I can't remember which boxer it is. I say the quote all the time. Everyone has a plan until they get punched in the mouth, right? That's exactly how the rest of us function with the markets. We say, this is the plan, and then we get punched in the mouth and something happens and we got to deal with it. But if I could make a couple of points about where I think we're going, there's sort of 3 big topics that we've got to deal with. 1, if you sense the theme, we got to deal with inflation. It continues to sit around 3. It will not come down to that 2% target that we're trying to get to. So getting from 3 to 2 is going to be a problem. It's going to be difficult. There's sort of a few things that will probably happen there. 1, you're probably looking at higher interest rates for longer than we otherwise thought. When the year started, the market was saying they thought we were going to get 6 interest rate cuts. When I say an interest rate cut, that's 25 basis points or 25% of 1%. So if we get 6, that's 1.5% of rate cuts, meaning if we're at 5.25, we're going to get somewhere around 3.75. That's sort of how that would work when you hear that. Now the market is saying, well, we might get 3. we might get, 0.75%, right? And if you listen to a lot of economists, they actually think we're now running the risk or the likelihood we might not get any, right? And there's one big reason why that is. It's point number 2 of what's important this year. It's the election, all right? So the Fed is supposed to be non-political. That is a huge mandate of theirs. Now, over the last 15 years, they've sort of been dragged into the political spectrum more than they would otherwise like. I think if you ask Al in confidence, he'd tell you he hates being on television and he hates either of our former, our current president and our former president talking about him. But that's just the way of the world. It's the world we live in right now. And so he's got to deal with it. So if lowering rates is traditionally good for the economy in general, right? Again, that whole like household spending thing, if your loans cost less, that's good for you. You'll spend more money. Your credit card rates come down, that's good. You'll spend more money, things like that. So the next time he'd be eligible to lower rates in a normal schedule is June. If he doesn't lower rates in June, which I think is looking more and more likely like he won't lower rates in June, the next possible time he really could do it would be September. And that is dangerously close to the political election. And here's the problem he's got. If he doesn't lower rates, the left is going to say, oh, you're not stimulating the economy because you're favoring the right. Okay. But if he does lower rates, the right's going to say, well, you're only doing this because you want to stimulate the economy and make, Mr. Biden look good. And so that's really where his sort of conundrum comes in. So I think what he'll do is if he doesn't lower rates in June, and I think it's a coin flip's chance that he does or not, I think he'll probably telegraph that we're not likely to see rates barring any significant economic problem for the rest of the year. That's probably what I think will look like. What I mean by significant economic problem is like a full-on recession. If the economy, again, just for everybody's understanding, a recession has nothing to do with the stock market. That's an economic term. That gross domestic product, which is all of the stuff we make, all of the tax dollars we collect, all of the imports and exports and all that stuff, you add it all together, all the spending, and that figure is GDP. If GDP is negative for 2 consecutive quarters, so 6 months rolling, that means we're technically in a recession, according to the economy. Typically, when you go into a recession, the Federal Reserve lowers rates almost always historically. That's sort of, for lack of a better term, Powell's get out of jail free card. We go into a recession, he'll be freed up to lower rates in the fall. Otherwise, I don't think we get any after the June rate hike or rate view. Makes sense to everybody? Okay. As it pertains to the election, I typically avoid trying to talk about this, but it's pretty hard to ignore considering it's coming up in a few short months. Historically speaking, the markets have not cared which party is in charge, Republican or Democrat. You look at any data set, some time periods, the Republicans do better, sometimes the Democrats do better. But if you look at the history that happens around those presidents, it's oftentimes not their fault or not their benefit. It just kind of was what happened during their presidency. What does matter, though, for the election and where I would like you to pay attention is in 2017, there was a bill called the Tax Cuts and Jobs Act that was produced. It lowered everybody's marginal tax brackets by a few percentage points, which was big. It also gave corporations some significant tax breaks and also did some other things for tax savings. It made it difficult to, itemize on your tax return. All of that expires in the next couple of years. Why that matters is the biggest topic right now is what are we going to do about the federal deficit, all right? It's growing all the time. The number one way the government battles that deficit, besides the obvious one, which seems to be that it's not spending more money, but besides that one, the number one way that they offset that deficit is revenue in the form of tax dollars. All of us paying our tax bill is the number one source of inflows for the government. No surprise there. Well, if they allow the Tax Cuts and Jobs Act to be extended, the presidents have that authority. They can extend the provisions that were there, keep your tax rates lower, keep the corporate tax cuts in place, all of those types of things. That will overnight add $2 to $3 trillion of additional deficit to the government. Because they're hoping, or they're planning on in 18 months or 2 years, all of us paying 2 to 4% more in taxes, which means 2 to 4% more in revenue for them to offset their deficit. If they choose to extend it, that means they don't have that additional revenue. So what does that mean for all of us? That means that they've got to figure out a different way to tax us, is probably what that means, in just all honesty. And there's a bunch of different ideas out there about how that works. And I won't necessarily conjecture on how they might figure that out, but I do think that that is a really important thing in the political spectrum for us to pay attention to. And to be honest with you, that particular topic doesn't seem to be clear-cut Democrat or Republican. It just seems to be a topic for debate. So I would be paying attention to what Mr. Trump and Mr. Biden are saying about whether they plan to extend or allow the Tax Cuts and Jobs Act to expire here in a couple of years. A really important thing I think should be paying attention to. All right, the third and final thing that can be quite disruptive to us is the geopolitical spectrum, particularly as it pertains to the price of oil. As I told you, one of the number one drivers, one of the three drivers of inflation is demand. There's a constant demand for travel. I need to drive my car to work. I need to drive my car to go pick up my kids or go on vacation or, whatever that is. Major companies need to buy oil for production and manufacturing and all of these types of things. Well, currently the supply is here and the demand is meeting that. But if the geopolitical spectrum over in the Middle East gets too severe and we see some sort of supply shock to oil, meaning there's just less oil available, that means the supply goes down, but the demand is still up here. Prices will skyrocket on oil, and oil is a huge driver of inflation. In fact, the last two inflation prints we've had in February and March, the number one reason they've stayed high is oil. And so we should be paying attention to how that kind of plays out, for lack of a better term, over the next 6 to 8 months, because I think that will be very, very important. Obviously, if we choose as a military organization to get involved in either of the conflicts outside of just normal peace talks in the UN and things like that, that can also have some downstream ramifications, of course. But the higher probability thing is that the price of oil becomes a really big story for why inflation stays higher for longer. The final thing that I would kind of just throw out, and oftentimes I get this in a question and answer, and so I'll just kind of address it now, is AI. All right, so the last theme for the year is artificial intelligence. If you've paid attention to the market at all, you'll know that NVIDIA has just torn the cover off the ball over the last 18 months. Quick stat for you, NVIDIA, since the start of 2023, is up 450%. 450%. So every dollar you add in NVIDIA made $4.50. That's pretty darn good. The number one reason of that is they are really on the cutting edge of artificial intelligence and chip making. They are just far out in front of most of their peers in that storyline. What artificial intelligence really means for us over the next 3 years is unclear. But what I can tell you is it's been around for a lot longer than you think. It's been used for a lot longer than you think. It's just becoming more of a popular storyline now because of some of the more interesting uses for it right now, where they're creating almost human-like interfaces to interact with people and things like that. But in my experience in the investment world, I've interacted with AI probably every day for the last 7 or 8 years. And AI impacts decision-making around model portfolio selection and how the markets are gonna go and how people buy and sell. And what I can assure you is artificial intelligence is basically useless without a human being giving some sort of gut check at the very end of it. And that's really just because AI is really good at telling you what the data says, but you still need a human being to look out in the world and say, does that really make sense with how people feel about the markets right now, with how people, are behaving? So I think that that's something really important. But what I do think it means is that if we use AI the right way, it can mean really good things for that federal deficit that I was just talking about. And what I mean by that is, remember at the very beginning, guys, I told you, money supply is only a problem in the absence of growth. If we have growth, the money supply is not an issue. If we have growth, the deficit is not as big of a problem as it might otherwise be. And AI, if used correctly, and it allows us to make more stuff quicker and better, and we can monetize that as a country and as corporations here, I think that that's a huge benefit to us in combating that future spending problem. And so that's something I would keep in mind with artificial intelligence. Overall, that's sort of the then, here, and now, and where we're going forward. I do think Ben's going to come back up and we're going to do some question and answer with you guys. So thank you so much for letting me speak, and I look forward to talking to any of you after the event as well. Thank you very much. Mr. Steven.
All right, thanks, Ben. You can see why this man up here is just a great resource for us. Anytime you guys ask us questions about your portfolio, he provides a lot of commentary for us as well. So let's open the floor now to some Q&A. Anybody has any questions? Ben covered a lot. It'd be hard to imagine what's left out there. Any questions?
Somebody.
All right, Tom.
Commentary on Social Security,
As it pertains to whether it's gonna run out or not.
whatever,
Yeah.
What's the future of it?
Yeah, so the question was commentary on Social Security. So a few things there. One, the biggest problem facing Social Security is, well, I guess I could say this because I'm a millennial, my generation. And the problem with my generation is there's just not as many of us as there was in the baby boomer generation, and we're having less children. So the basic premise of Social Security says people who are currently working pay into the system, and in a roundabout way, the money that we're paying into the system right now benefits the people that are taking Social Security right now. That's sort of how that cycle works, right? It's sort of relying on the next man up to provide for it. So I think Social Security probably faces a big moment as it pertains to the Tax Cuts and Jobs Act, actually. So I think if you see TCJA extended, which, as I just said, means that the deficit is going to increase overnight, they've got to find a different way to tax us. It wouldn't surprise me if Social Security is one of the places that they look, unfortunately, for that. Now, as far as how long is it going to be funded, how long are they going to keep it? To be honest with you, based on the legislature, people that I talk to, and some of the rhetoric around Washington, I don't know if they have a choice but to continue it. I think to not would be so destabilizing, at least in the current regime. This year is a peak year for people of the baby boomer generation retiring. There will be more people retiring this year than any other year before it. And so you can't cut one of the number one forms of stimulus for retirees in the year that you have the most people ever retiring. Do I think my generation probably needs to very wisely figure out how to save for their retirement without factoring Social Security in? Yes, I absolutely do. I talk to my friends all the time about it, and I think that the truth of the matter is that we have, it's technically known as population deceleration. There is a rapid drop in the just sheer number of people that are being born and working every day. And so we've got to address that problem. And ironically, not just a US problem. If you pay attention to China at all, the number one problem that they have right now is population deceleration. It's killing them. The one child policy that they had in place for many, many years has, because they were facing famine and starvation and all of these problems, it's come home to roost in the form of a way I don't think they probably anticipated that it would, but it's causing their economy a massive problem. And so I don't think we'll be to that extreme, obviously, but I think that it's something we've got to very much pay attention to. Is that helpful?
I have a follow-up to his question. In your opinion, would you be more advantageous to collect Social Security at 62, wait 65, 67, or go to that 70 mark as far as withdrawing?
Yeah, great question. So the question was more of a follow-on to the Social Security commentary, which is, what is the appropriate age to optimally take Social Security? The truest answer, guys, is it really depends. It really, really depends. I think that there's sort of two things at play here. One, I would just kind of harken you all back to the plans that have been crafted here so wonderfully for all of you. I would say that I work with probably 400 advisory firms all over the country, and I don't get paid to say this, but I would say your team here at Integrated is by far one of the best. They are just so excellent at planning and how they think about all of those things, social security, how they think about taxes and the market commentary, and taking all of that stuff that we just talked about and making an informed decision. Because the truth of the matter is with social security, thinking about the scarcity of it can lead you to want to take it early. But if you have sufficient income to take care of what you've got right now, I would then think about delaying it to 67 or 68 or 69 and so on and so forth. It used to be that you would want to take it a little bit earlier because people weren't living as long, but that's sort of gone by the by. People are living quite a bit longer now, thankfully. And so it sometimes makes sense. So I guess what I would say is it just depends, honestly, on how that plan is crafted, where you need the income from, and what makes the most sense from a longevity standpoint.
Let me add to that just a little bit. So we have the tools, necessary to run this kind of analysis. A lot of people, they come in, they kind of want a black and white answer for these things, but it really does depend. A lot of it has to do with the taxes, and what our job is to kind of take the emotion out of it. Just like some people are worried maybe Social Security won't be around long enough for them to see it. We want to take all that emotion out and just show them, sheer facts. These are the numbers, and this is what the numbers tell us long-term is the best decision for you. Any more questions?
Yeah, just for Ben, I understand you help kind of develop these portfolios and make the recommendations for your clients, right?
Yeah.
And what's your biggest challenge in putting these portfolios together? Like, I hope you pick a lot of NVIDIA and stuff like that. But what's your biggest challenge in trying to, build these portfolios, consider what managers are the best managers to pick? Because obviously I like to see you beat the index funds, right? I mean, all the time. That's kind of what we're hoping for, right?
Sure.
So what's your biggest challenge? How do you get around that?
For the folks in the back, what Mark asked was because Ben helps with the portfolio development, kind of what are the challenges that he sees, and maybe a little bit some of the strategy that goes behind that.
Yeah, great question. Thanks, Stephen. So when it comes to building portfolios, there's sort of a few things that happen there. First of all, we always start with the 10,000-foot view, the long-term view. I told you that markets work, and we want to reflect that in the way that we manage portfolios, which means we know we need to own large diversified exposure, because in any given year, we can't necessarily determine what's going to do the best versus another, but we do know that there are certain things that over 10 years work really well. So we always start with that sort of 10-year outlook. That's our basis. And then we're going to look over the next 12 months and try and figure out, do we want to be more growth or value or domestic or international or technology or consumer staples or things like that? So we're creating that sort of short-term reflection. I would say the biggest challenge then is sort of, NVIDIA is a great example of this. We want to own NVIDIA, but the problem with owning too much NVIDIA is you own too much NVIDIA, right? So the tricky part is that I want to own enough of it to matter and contribute meaningfully to your portfolio, but I don't want to own too much of it to where if NVIDIA has a bad day at the office, all of us are having a bad day at the office. So that's why diversification is so important. There's a sort of saying in the portfolio manager room that I work in. It's sort of on the wall. It says diversification means always saying sorry for something. And what that means is if you look at your portfolio and you say, gosh, everything did really well, stocks, bonds, cash, all of that, it probably means you're not properly diversified, because you were only set up to do well in this market. In the market where all of those things are going to do bad in, all of your things are going to do bad in that market. And so when you're in the accumulation phase of your life, meaning, you're my age and you're just trying to gather assets and grow and all of those types of things, you can afford to be that risky. But the second you need that money for utility, the second you need it for income or legacy or other plans and things like that, you have to be much more risk-based first. And so we try and be well diversified, but lean slightly into things like owning a little more NVIDIA than the index funds, but not too much to where we sort of jeopardize the overall plan that you guys are allocated to. And so that's the biggest problem, is the art is in how much of it to own, how much of that sort of weighting. Yeah, great question.
All right, we did get a question from one of our online viewers, regarding cryptocurrency. You know, that's how Ben made his fortune, so he knows quite a bit there. I guess how it pertains to the retiree's portfolio, and then what's the future of it look like?
I should have just covered crypto with AI. I think I get that question every time. So just so we're all again on the same page about cryptocurrency, that is the digital currencies exchanges that have become so popular. Bitcoin obviously is the most popular one. Ethereum, Litecoin, there's other digital assets, if you can believe it or not. The reason it's become so interesting is because for the very first time, you used to not be able to buy cryptocurrency except through a very specific application, through a very specific exchange, and it was kind of murky what you owned and how to sell it and how all that works. Well, now there are actually exchange traded funds that you can own cryptocurrency through, which has brought cryptocurrency to the average consumer. And that's sort of interesting. Now, the best way I can describe it is we don't currently own cryptocurrency in any of the portfolios, and I can very simply explain why. When you go to buy something for someone, you have to understand sort of three really important things. How does it make money? How does it lose money? And if it goes bankrupt, how do I get my money back? So if Apple tomorrow goes bankrupt, I know that I have a claim over Apple's balance sheet as an investor, as a stockholder in that. I own a partial share of the company. That's what a stock is. I can get my money out from Apple through that bankruptcy. The problem with cryptocurrency is it's not backed by anything. It's not backed by the gold standard. It's not backed by the dollar is backed by the full faith and credit of the US government, right? This economic stability of cryptocurrency is not. There is no promise of any of that. And so it's driven by pure supply and demand, like how much people want it versus how much people don't want it and what supply is out there for them to get it. And then there are more confusing things like in this past, year, cryptocurrency says, I have a defined amount. There's only so much Bitcoin out there for you to get, but then they halved it. So they doubled how much was available. And that changes the dynamics of it. And so the truth of the matter is, I consider it to be a very important step forward in the sense of how global economies might interact down the road. I think it's something that will become more prevalent because the security aspect, the privacy aspect, the ability to prevent anti-money laundering and some of those types of things is immense within cryptocurrency. There's some really amazing features that are built into there, but as it currently exists today, I just don't see it being something that's worthwhile to invest in a large scale because there's nothing driving it other than just how people feel about it on any given day, and that's a huge risk to take in a portfolio.
Any comments on the R&D outlook going forward? I mean, there's been a lot of changes the last couple of years. And we talk about how Social Security and your time was running over the change. You see anything in the soon horizon that's going to change further?
All right, Mike's question has to do with required minimum distributions. We've seen some changes in the past few years. So do we foresee any changes in the future?
Thanks, Stephen. Great question. So the first answer is I'm going to sound a little bit like a broken record here, but it really depends on what the government decides to do with taxes. So if the federal government says we're going to extend TCJA, Tax Cuts and Jobs Act, we're going to do some other tax cut provisions to try and stimulate the economy, they're going to have to look for other ways to drive revenue to them. I think that it's certainly on the table that they actually lower RMD age at some point because they need more people to be paying taxes on RMDs than previously before, which is why I know that, I talked earlier about how wonderfully the folks here are and integrated for their planning. Things like Roth conversions and things like that are so important because yes, you pay taxes on that conversion, but you are opting into that tax and you're doing it understanding that tax rates probably have to go up in the future at some point. So you're short-term pain now for avoiding a much bigger pain later. The other ironic thing here is if they find other ways to stimulate the tax revenue in the economy, the likelihood is they will continue to extend the required minimum distribution age. Or I could see them going away with it altogether, actually. And what I think they'll do at some point is tax maybe IRAs that are above a certain dollar amount. They'll just start sort of doing some sort of like annual tax on those for your 1040 and things like that. So I think it's a really kind of, the RMD thing depends on a bunch of other things. To answer your question, I think they could go either way. If I was a betting man, like, 50-50, I have to decide right now what I think is going to happen. I think they'll continue to extend the RMD age to, 77, 78, 80 years old. Yeah. Good question.
All right, I don't want my email to be blown up over the weekend with questions that we have to have. All right, well, thanks, Ben. Appreciate it. Tracy's gonna come up and close and, you guys a farewell.
Definitely just want to thank Ben for his time and just the relationship we have. He's just a really great resource. And it's nice that you came to our lovely Akron. He said to us, he said, we met him last night for dinner and he said, thanks for all the construction and rain. And I said, well, Ohio tourism at its best, right? Well, again, we just want to thank all of you. We are so privileged to do what we do, and it's only because of you that we get to do it. And we love this opportunity to kind of get back to you and make sure that we're in front of you and we're keeping you informed, because our goal is to make sure that your plan is secure, that we take care of you through the years. And so we are so grateful that you continue to do this. Ben already stole my thunder on our next time that we will be together. So that is our client appreciation event on May 23rd. We have some flyers. Make sure you save the date. It is going to be one you're not going to want to miss. So we look forward to seeing you there. If you have questions in the meantime, of course, you know that we are always here for you. I want to thank again the team and the staff at Firestone. A little tighter quarters this morning, but how nice and cozy it is. And I think you have a little break in the rain to get to your car. So thanks again so much, and we're here if you need anything else.